Alrighty, well, thank you everybody for coming. Hey Kyle, I just want to try to start if you could keep it down a little. Thank you. Alright guys, so I'm Jon West. I'm working with the co-op and with Reflective. My specialty is around like trading and liquidity. I used to be a trader at Citigroup, where I traded with the fine Luigi over here. We traded credit default swaps together. I also traded FX forwards. I was an intern at Bridgewater Associates. And then I was Mike Novogratz's first hire. If any of you guys know him in the crypto space. The whole team was me, him, a lawyer, and a secretary. And that's really where I got my feet wet, trading crypto, harvesting liquidity, all these kind of things. After working for Mike, I was a co-founder of a company called Omega One, which was like a liquidity aggregator trying to do like programmatic trading. And now I am here. So let's jump in. So there's going to be 3 parts. After each one, I'll take questions. It's going to be less on tokenomics or crypto economics or anything like that, and more around like risk management, trading, and all the things to know, because the art-chain space right now is actually pretty crazy in a lot of like kind of ways that I wouldn't expect very many people to know. And I think it could be really useful. So part 1 is going to be charts and trading. What's a good chart? Why do we care? Whatnot. Part 2 is going to be art-chain trading ecosystem case studies, where people can trade art-chain, what those exchanges look like, should we trust them, etc. And part 3 is going to be portfolio management. So like, how do we try to buy low and sell high, manage our risk? You know, maybe we're getting paid in crypto. Who knows what? If we can try to put some parameters in the way that we think about trading, maybe we can make some progress and not have to stay up all night staring at charts. So why trade crypto? Here's just some reasons why one would trade crypto. My favorite is not having to work for the man. What's special about trading crypto? So crypto is really interesting, right? Like, it's exceptionally volatile, providing all kinds of insane risk rewards. The technology in itself is really exciting, especially these moves away from proof of work to proof of stake. Even ICOs themselves, right? No minimum investments, it's a global world, and also there's like a crazy amount of scams, schemes, etc. that you just normally don't see in very many markets. Somewhat with like penny stocks, but not on this kind of global scale where a lot of people are doing it. So let's define some terms. We have long, which is I buy something. So like I take my dollars, I put them into some asset, I hope the asset goes up, at which point I can sell it and get more dollars. Short and margin. That's kind of like doing the opposite, which is, say that I wanted to short Ripple. I borrow some Ripple from someone, and then I sell that and I get dollars, and then I hold on to the dollars and hope that Ripple will go down. Then I buy back the same amount of Ripple, and my leftover amount is dollars. That is a little bit more complicated because you need to find someone who's willing to lend you the underlying asset who believes the opposite, that it's going to go up. And then you need to pay them a certain amount of money per day, per week, whatever your arrangement is, and that's called margin. So shorting things is more expensive than going long things in general, because you have to pay an additional premium to incentivize someone to give you their asset and let you hold on to it every single day. HODL, that's like, well, you know, what all the non-traders say, just hold on forever. But as we'll talk about, sometimes you just can't really do that. Alt, as in like altcoin, anything that is not Bitcoin is considered an alt. Market cap, that is like the total price of the thing times however much of the thing exists. Some people think of it in terms of what's the current amount that exists, but I like to think of it as in when there are no more coins ever minted, how many coins ever will exist. And that helps you cut through a lot of these schemes where, you know, some guys only put 2% of his coins into existence, but if the thing goes up a lot, he's going to print, you know, 50 times as many. Percent down from all-time highs. That's one of my favorite metrics. So if you look at where things were when they were at all-time highs and then where they are now, if you measure that percentage move down, that can lead to really interesting things that we're going to talk about, which kind of leads into the risk spectrum. Bitcoin or larger market cap things in general are much less risky than smaller market cap things, right? So it's some kind of risk reward where small market cap things, something might be a $10 million market cap, you know, maybe it'll replace Bitcoin one day. That's a $100 billion market cap. Huge reward if it's right, but not that many people believe in it. It's some new technology, still trying to prove itself. High risk, higher chance it's going to go to zero than something like Bitcoin. At the same time, really big things, Bitcoin, Ethereum now, etc., are really large market caps, and they're going to be much more stable. So you're going to see when times are bad in the market like we've just experienced and things go down, things like Bitcoin and Ethereum in general are going to do a little bit better than the more risky things. And when things go up, the more risky things are going to do a little bit better. The term beta is a common trading term, which is kind of like measuring something against like a base case. So when we talk about altcoins, a lot of times we measure their beta relative to Bitcoin. So if Bitcoin went up 10% today and an altcoin went up 20%, we'd say that's like a beta of 2 to 1. And the same exact thing if we're going down. If the altcoin went down twice as much as Bitcoin, we're going to be like its beta is twice as much as Bitcoin, which is how we start to think about how we manage risk and how much risk we take. Leverage, same kind of idea as margin, but in leverage, say that I have $10,000. Sometimes an exchange or something will let me borrow even more dollars and make an even bigger bet. So say I had $10,000 and I bought some Ethereum at 500. And the exchange is like, hey, I'll let you borrow another 20,000 and you can buy even more Ethereum. So if it goes up, I'll make 3 times as much money. But if the thing goes down 33%, the exchange is going to fully wipe me out. So what it's doing is it's lending you more money, but it's essentially tripling the size of your bets. Whereas normally you could survive, or normally you run out of money when the thing goes down 100%, because then you have no more money. If you take on leverage and you do 3x leverage, then if the thing goes down 1/3, 33%, then you're wiped out. And the exchange liquidates your position, takes all your money, and you're very set. But sometimes leverage can be really useful when quantifying risk rewards, where it might make sense to take out some leverage position where you have some thesis that it'll never go down more than 20% or something like that, and you have to put up less money to get the kind of exposure. Last one is called a stop loss, which is just some way to manage risk, and that's what's saying, hey, look, I bought Ether at 500. If it goes to 350, I'm going to sell it and get out. And that's like my level where my thesis is Ether is going to change the world, and if it hit 350, that would invalidate that. And stop losses are just some way to try to manage your risk, where some quantified way to try to say that you're wrong and get out of the position. We're going to explore all of these things more later. All right, so what do we want to get out of this? Some understanding of what's going on in the world. How do we pay attention to markets? How do we see when scams come? All these kind of things. How do we protect our neck? A sense of derivatives and altcoin volatility and leverage. So how can we go further out on the risk spectrum at certain times to possibly enhance our risk reward? And just how do we think about that? Should we always hold all kinds of risky things? Should we hold no risky things? How can we try to quantify things to properly manage risk and feel like we're in control and not just feeling all the ups and downs every day of markets? And why should you care, right? We're at a dev conference, why should we care at all about trading crypto, right? But as crypto gets more adopted, a lot of people here get paid in crypto. You might have dollar liabilities, you might get paid in crypto. You're going to need to know how to convert it, how to trade it, how when you trade it not to lose a bunch of money, having the market try to run away from you. Any of these kind of things. And I think what I'm going to do today, hopefully, is going to be useful. Plus, too, if you're building protocols and the underlyings have this kind of psychology, maybe there's something useful in there that could be a takeaway. All right, so pop quiz. Does anyone know where anything is trading, the price of anything? Anyone know where Bitcoin is? What's the current price of Bitcoin? Anybody? Yeah, that. 81.76, but yeah, who's counting? Anyone know what the price of Ether is? Yeah, 520. This is pretty good. Anyone know the Ether Bitcoin cross? It's about 0.063, and what that means is 1 divided by 0.063, call that 30-ish. 1 Bitcoin will get you that many Ether. Anyone know in capital markets, what's the price of the S&P 500? Right? We normally don't pay attention, but that stuff can sometimes kind of matter. If we're in 2008, that might have an impact on crypto. Current price of the S&P is 27.10. It's about 4.5% off of all-time highs. Are tariffs bullish or bearish crypto? Does anyone have a strong opinion? So there's global tariffs, right? We're in a trade war with China. If we ramp up all the tariffs, costs that we charge China when we import things, and they do the same, is that good or bad for crypto? Yeah, I think probably good, right? But who knows, right? For trading, you get to express opinions and such. And then we're going to talk a little bit more about derivatives and leverage. So shout out to June 2016. This is what people cared about back then. So interestingly enough, ETH Bitcoin was the #1 topic of conversation. People cared about that more than the Bitcoin price or the Ether price inherently. They really love to look at the ratio of where things traded. Capital markets were still at all-time highs, even though they were like 20% lower. We cared about Brexit, and we were all freaking out about the Dow, which is my favorite thing that ever happened in crypto, and so much fun. And one big question at the time was, when we try to trade the Dow, should we think of it in Ether terms, or Bitcoin terms, or dollar terms? And fun shout out to how I thought about this stuff in 2016. So here's what we need to know, right? 1 ETH bought you 100 Dow tokens at par. If we did a hard fork, how many ETH would 100 Dow tokens get you, if anybody knows? 100. It traded at par, right? Everyone gets their money back. We do a hard fork. We pretend the Dow never happened. Life is great. They did a soft fork, and the way that was going to work was all the miners were going to collude together and just censor that guy's transactions, essentially saying he could never spend any of that money. It could never get in a block. He was going to be essentially frozen out of the protocol. And then if we found some sneaky way to burn the money, right? And the attacker stole 35% of the money. So can anybody guess where the NAV would be of the Dow? Like 65 cents on the Ether, right? Because we burn all his money. We say, hey, the Dow's probably a bad idea because some guy can steal all the money now all the time. Let's like refund everybody. Everybody gets 65 cents on the Ether. And then what's the Dow's NAV? Fun fact, the Dow's NAV was like 1.03 because the way the Dow worked was you could do that 100 Dow tokens for 1 Ether on the first day, and then day 2, you'd have to 1.05 Ether got you 100 tokens, and then 1.1. And some people just missed the day 1, piled in later, and the total NAV of the Dow was like 1.03. So a little bit extra money even if everybody gets paid back. Does anybody remember like what the big fears were if no one got paid back outside of Code is Law? There were like massive lawsuits against the Ethereum Foundation and all those people who don't care about, their poor token holders, and everyone's going to get sued, and the whole project was going to get shut down, and it was like a good old big drama. So let's look at how the Dow traded, right? So we can see up here at the very, very top, this represents like 0.00095. That's like, you get back 0.95 Ether for 100 Dow tokens, right? And then the attacker does this hack, and we trade all the way down to like close to 35 cents on the Ether, right? The reason I liked this trade so much was because at 35 cents, even if the attacker steals all the money, there's still 65 cents worth of NAV there, and I can like start to define like a pretty good risk reward. This chart though I really like is because this is almost like a credit event, and there's an inherently baked leverage piece of this, which is if I can buy this thing at, instead of 35 cents, 30 cents, and I can get out at say 65 cents because they only do a soft fork and the attacker gets the rest of the money, right? I go from 30 to 65, and as like a percent change term, that's like 120%. If it's at 35 and I go to 65, that's only like 90%. So every incremental penny the Dow dropped in addition was like a further exponential increase on the reward. Where you can imagine, right, if this went all the way down to 1 cent and I got back at 65 cents, I made 65x on my money. So this is a good example of like leverage volatility in derivatives where like every 1 cent it goes further down, your risk reward changes a good little bit. And you can theoretically size your position smaller and get the same kind of reward on like a hard fork. Also birthed the good old bastard child of Ethereum, Ether Classic, which was like its own fun drama. So if we look here, right, when Polo listed Ether Classic at 1 a.m. on a Friday night, didn't tell anyone, really caused a lot of mayhem and chaos, right? So it traded from 30% of a market cap of Ether, which is what this chart represents, all the way down to 6% of a market cap of Ether. Then all the way back up to 45% of a market cap of Ether. So if you were somehow able to buy this at say like 8%, which means you converted your Ether into Ether Classic at 8%, so 1 divided by 0.08, and that means that you get whatever the math equals, 12.5 Ether Classic for every 1 Ether you put in, and then you somehow were able to take it out at like 40, you're looking to get back like 5 times as much Ether. So these derivatives I think are really interesting because you can really get huge amplified things in them that like you don't normally get when you make $1 investment in something. And it's just a useful way to think about risk and risk management. And it's really important to understand that in derivatives you can take a lot of risk inherently. And you might not think you're taking a lot of risk, but it's really useful to try to understand how you're taking this risk. So here's it broken out, right? And Ether, this is a chart of Ether versus dollars during this time, and Ether Classic versus dollars. And you can see the two are like really strongly negatively correlated. So like when Ether went up, Ether Classic went down, and when Ether went down, Ether Classic went up. And there's all this fear that Ether Classic is going to replace Ether. And you can imagine, if you're taking a bet in Ether versus Ether Classic, it's almost like you're amplifying that bet, right? Like if you're making money because the thing you bought with Ether, you're also making even more money because the Ether Classic terms are going even lower. And it's just like a way big bet. So like you might just think, oh, should I hold Ether? Should I hold Ether Classic? It's not just like a normal trade. Should I buy Bitcoin? Should I sell Bitcoin? It's like an amplified bet with like 5x on your money or risk of ruin, ramifications. Fun enough, we traded very similarly. Here's the chart again, and where you can see this kind of 5x and then all the way back down phenomenon. But we traded really similarly with Bitcoin Cash versus Bitcoin. So if we remember back in November when everyone was freaking out about how exciting Bitcoin Cash was, Bitcoin Cash had this huge spike up started all the way around 500, really started like 350, all the way up to 2,700. And Bitcoin did the same inverse kind of performance, including when Bitcoin Cash went down and Bitcoin went back up, to lead us to the super amplified chart again, right? Where we can see that Bitcoin Cash was started off as maybe 10% of the value of Bitcoin, got all the way up to 52% of its value. So how can we use derivatives to essentially quantify our risk and be able to take, say, smaller bets where the thing goes to zero, we're not that upset because we only put in a little bit of money, but possibly try to get some really large upside? And is that ever better than just buying a coin, right? It's just not saying it is, not saying it isn't. I'm just saying this is another tool in our arsenal that not very many people think of that could be really helpful. Also, here's a fun chart of Ether Classic. Didn't do so great at the end of the day. Also, I like the DAO, right? Lots of drama. We haven't seen one quite that good ever since. All right, so here are our top 8 coins. Can't read too much into this, right? They all kind of move together. Can we make this a little more interesting? Ooh, now we got like a bunch of data, but a bunch of numbers. Let's really shrink this down. So here are the top performers sorted by their percent down from all-time high. So we look at, say, the number 1 performer, Binance coin, which is some coin that lets you get reduced trading fees on Binance. So you buy the Binance coin, instead of paying 0.25% per trade, you're paying 0.15% or something like that. If you look at it, Binance coin has been the best performer by this metric, meaning all the crypto has fallen kind of together since Bitcoin hit that all-time high back in December. Binance coin has been the best performer as a result of how far down it was from its all-time high, more so than anything else. And we can also see our chain is in there at number 7, doing pretty well. And this can give us kind of an idea for portfolio management when we think about what kind of assets we want to own, what kind we don't. In general, for a long-term holding that I'm not trying to day trade very much, you want to own things that are not that much below their all-time highs when the market is under pressure, because that means that like they're really holding in there. Demand is holding in even though all the markets are selling off together. And in general, there's like a pretty strong correlation where things that don't go down that much relative to other things in a bear market usually end up winning more so over time. Here's the bottom of that list. Shout out to BitConnect, down 100%. Einsteinium, down 94%. But one interesting thing to think about is, say something is down 90%. If it goes from down 90% to down 95%, and you bought it at down 90%, and it went to down 95%, you're now down 50%, right? So like this is another example of this kind of leverage thing. The thing is down 90% and only goes to down 80%, you double your money. So the more things go down, and especially when we get below this like 87% kind of region, the more amplified these bets are and the more essentially swingy your positions can really become. So things I like to look for like just a trade, right? The opposite of like a portfolio management of something that I really want to hold. Things that really got their butts kicked and I like their teams. So one, for instance, I like is something like, say, Sia Coin, where I like their team. This is not financial advice or anything like that, but pick your thing that's down somewhere between 87 and call it 93%. Pick something that you have a team that you like, and maybe you make some really small bet and roll with the tide. But the thing that is important is you need to be more aggressive actively trading it, because just as easily as it went from down 90 to down 87, it can go right back down to down 90. versus something that's trading really well at its all-time high is going to be less volatile and you can be more patient with it. And just a fun fact, right? So we can see, right, because this chart is from about a week ago. This is much more fresh. Even though, and I did that on purpose because I just wanted to show, even though things are swinging around, right? Everything here has moved maybe 30%, including our chain, now up to number 5. You can see like the top 15 is like pretty consistent. So things that trade well in general continue to trade well. Things that trade bad continue in general to trade bad. And that's why things that trade bad, if I ever want to take them for a trade, I'm thinking in a shorter time horizon unless I have some crazy theory. Here's a chart of all of crypto outside of Bitcoin, right? So we can see, this is like altcoins here. We can see altcoins kind of bottomed like beginning of April, and they might go back down, but even as a percent change move terms, they've done like pretty well off the bottom, right? We went from $400 billion market cap to $130 billion market cap, back to like 190. And if you're able to catch that bottom, you can make like 50%, which is a way greater risk reward than at 400 billion, right? You would need to go all the way to 600 billion to make it there. So we can kind of see how like, if you can have some kind of metrics to like buy low or buy things when they're on real dips, you can kind of amplify your risk reward. So what do we think? Should we go all in on the strategy? Like put 3% of our money in like 33 different wrecked altcoins that are down like 90%? No, we definitely shouldn't, because if crypto keeps falling, they're all going to trade very similarly, right? They're all going to go from 90 probably to like down 95 really fast. And we're essentially making the same exact bet 33 different times, right? They're all going to be heavily correlated, right? It's very rare that like one of them is really going to wake up and perform really great, especially if all of crypto continues to go down. So let's update how we want to think about this, right? We should have, in my opinion, some core positions, which are things that we're not actively trading that much, that do pretty well as a percentage down from all-time highs, that we really believe in, we believe in the future in them, etc. And then some highly speculative positions that we trade versus some kind of lower bound of zero. So we size it so that way if it goes to zero, you know, hey, you win some, you lose some, we lost one. And we plan to aggressively take profit on. Much more so than the core positions we ultimately believe on that we think are really going to like change the world. And the more I find that you can break out the differential between those two types of trades, the better you're going to do, because if you try to turn one of the highly speculative ones into your core position, then it's swinging up and down so much, and then you're freaking out, and you're having FOMO, and I should have sold it. You're going to be up all night staring at your computer, which is like probably not how we all should be spending our time. So here's another chart I like, right? Again, this is not financial advice, but it's some project where I like the team in it. The thing is down 90% from its all-time high. I'd look to take it maybe for a trade if I want to take a trade and I believe that there's some kind of like bottoming in the altcoin market, say. So things I look for, right? Evaluate the team. Like, what is their track record? Are they masters of their domain? Do they have expertise in the field that they're in outside of crypto? Were they like rock stars before they got started in this project? Do they ship things, right? People in crypto never like to ship things. The few people that do really could be worth it. And then, is it time to buy? Yeah, maybe if it's down like 90%. Is it time to sell? Yeah, maybe if it went up at all after you bought it down 90%. Chart of Ether USD. And I like this one more than the one we're at 500 because you can really get a feel of how much pain we're in, right? Imagine like if you just bought this for the first time and like you just got into crypto, like anywhere along the way, right? It is like such a depressing, painful experience to hold onto that looks so hopeless. And like this is a psychology I want to start to explore, and maybe we can like figure out some way to not get caught up in the lows of it, because you know, you look at a chart like this, real people are losing real money, and that's like a big deal, right? Which leads us to this chart of Ether in its history. I don't know what anyone thinks. Do we think that this is too sustainable, or how we feel about these kind of things? What do we think? Do we think crypto is a bubble? Raise your hand if you think crypto is a bubble. Wow, a lot of core believers, right? So I would say yes, and I would say that's not necessarily a bad thing. Like if we look at the S&P 500, right, which in 2008 and a series of other times people have called a bubble. Over 20 years, right, it's gone up 3x, and then sometimes it's gone down like 50%. And people say that's a bubble. So to me, I would call this a bubble because thing moved a lot up, and then thing moved a lot down, and it's nothing more complicated than that. But if you look historically, all great asset classes go through a bubble, and it's usually a really strong sign that they're a really life-changing historic asset class, whether that's trains, whether that's airplanes, transportation, canals in the 1800s. Canals went through 3 periods in the 1800s of going up 5,000% and then down 90%. And then 5,000% and then down 90%, right? The Panama Canal, right? That changed the way we ship goods. It's a big deal, but that's still a bubble. So say that we think that whether we're in a bubble or not, right? This is a highly speculative class. The more we can think about how we quantify these trades, short-term holdings, long-term holdings, manage risk, any of these kind of things, the more we're going to be able to protect our neck. And at the end of the day, when a lot of people lose a lot of money, it's really not funny. Yeah, and there's another question too, right? Should we even actively trade it, right? And you do pay more taxes if you do actively trade, but I would argue that managing risk is really important, and if you don't want to do any of these kind of things, like maybe you really shouldn't invest in crypto, right? Maybe you should just figure out what your US dollar liabilities are and hold or at least make sure that those are guaranteed hedged and don't take crypto risk. Fun chart. All right, so let's look at these two charts here, right? Here's Ether, and we can see, right? Ether kind of down here is still somewhat above before it really started taking off. Compare that with NEM, New Economy Movement, right? It went all the way back down to where it started from when things got exciting. And in general, when you have charts or any kind of asset that performs with this kind of chart pattern, the more it retraces or the more it goes back to where it started on the whole big move, historically, they don't do so hot. So maybe you might want to take this for a trade and make a stop loss or sell out if it gets down here or something, but I would not want to hold this for like a long-term position. My 2 cents, not investment advice. For something like Archain, right? Look at Archain, even though it's been a very tough trading environment, as a percentage down, we're still doing pretty well, and we're not back in like this region before everything all started, which makes me feel better about it from like a long-term portfolio perspective. Tether's a fun one, right? Can never go above $1, right? But sometimes it does, right? Isn't that interesting? It gets all the way up to $1.04. If you could just like consistently have some strategy, you could like make good money, you know, selling tethers above $1. And this, like, why does that? Anyone think about why Tether trades above $1? I mean, my theory is because digital dollars people like much more than dollars in their bank account, and that can be traced, etc. But it's just like an interesting dynamic, right? So Tether has these pressures between people wanting dollars online that are relatively untraceable because I don't know who uses Omni or anything like that, versus, you know, you can never actually get your money out and they don't do wires and all their banking gets shut down, etc. And somehow that kind of equates out to a consistent price of $1. Because hey, here's a chart of Bitcoin, right? Very similarly like painful, but not quite as painful as Ether. Again, Bitcoin is less out on the risk spectrum than Ether is, higher market cap, something that we would expect. Here's the long-term one again, right? We're not all the way back into this real pain area. We're like holding in there, not quite as bad. Here's a chart of Ether Bitcoin. So like this just shows you how amplified the move down in Ether was relative to Bitcoin, right? So however painful this Bitcoin was, you can square it for Ether and just like, you know, see how we dropped from this 0.1 to roughly 0.05 for an additional extra 50% down in Ether. Here's a long term of ETH Bitcoin, right? We went all the way from 0.02, meaning 1 Bitcoin got you 50 ETH, all the way up to 0.12, all the way back down to 0.028. So it's like really swingy, but again, this is this kind of like derivatives leverage kind of trade here where, you know, if you turned your Bitcoin into Ether at 0.02 and you sold it at 0.1, you end up getting 5 times as many Bitcoin as where you started. So yeah, the reason I really like to get in this stuff is because it is no joke and people are losing money. And, you know, if you're a company and you're not thinking about these things and you have like a lot of people that depend on you and have dollar liabilities, right, you might really impact negatively a lot of people's lives. A lot of people, especially as more and more people get paid in crypto, really depend on their companies and their bosses and themselves to really like manage their risk and make sure that they're not biting off more than they can chew, and that they're not going to have to, you know, go back to working for the man in like some normie kind of job. Here's a chart I like called Bitcoin Dominance. So that's the market cap of Bitcoin versus everything else. So when this is up here at 95%, that meant that Bitcoin accounted for 95% of the market cap, all crypto, and everything else combined accounted for 5%. And we can see in this chart, right, that percentage got worse and then recovered a little, and then worse, lower than before, and then recovered a bit, and then lower again before recovering, before really having the wheels fall off. And in general, there's a good trading rule, which is if something makes lower lows, it's that should really send off risk alarms in your head. Things that make lower lows, in general, might have the wheels fall off way more likely than things that don't. Things that make higher highs might really ramp and really go exponential, way more likely than things that don't. So when I see something like this along the way, if you were owning Bitcoin, you should be getting a little bit more nervous when it makes a new low, a lot more nervous when it makes a new low. By the time it makes this new low, you should be getting really, 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 really nervous. And here's the zoom in, right? As we talked about how, altcoins kind of bottomed, we can start to see, right, that Bitcoin as a percentage, right? We can imagine when the markets are crashing, Bitcoin as a percentage grows because it's the underlying beta, it's the biggest market cap. All these speculative alts swing even more. So as markets are falling, Bitcoin dominance should be increasing. But as we can see, that's kind of been slowing down even ever since January, even as markets have been going down, which makes me less confident in Bitcoin and more confident in altcoins relative to Bitcoins. So yeah, don't buy things that make lower lows. And it's easy to get caught with your hand in the cookie jar and have the wheels fall out when you do. We got any questions? All right, Rick.
What's your favorite coin besides ours?
I don't want to give investment advice. Do your own research, guys. I think you got to turn it on.
So you mentioned that Tether would go above $1. And I was always under the impression that that was from trade pressure on exchanges that were denominated in tethers, right? So as there's activity, as people are trying to exit Bitcoin or Ether or whatever from Bitfinex, the reduced supply of Tether on that exchange is what causes the price of Tether to go up.
Yeah, and not even the reduced supply, I would say. The fact that you have your money on Bitfinex, and what does Bitfinex trade? Like Bitcoin, Bitcoin Cash, Ethereum, et cetera, et cetera. Bitcoin goes down, everything kind of moves uniformly, as the way markets often do when things go down. There's only one thing that's not really going down, and that's Tether. So, man, I'm really getting nervous. I really want to get out of my crypto holdings. Can't really get it in dollars. I'll take what I can get, which is tethers. Further demand for tethers. Spiking it up.
Yeah, and I think another comment, not question, is if you look at the DAI chart from CoinMarketCap, just to provide a little color and context. Even though the DAI was, the CDPs were stable the whole time, because of the pricing, because of the algorithm that CoinMarketCap used, the price was going all crazy.
Yeah,
so
right.
There's a really weird relationship between CoinMarketCap and stable coins, because even though they are a crypto asset, they're because they're backed, the irrationality of the market, when an exchange literally just is emitting bugs or doing something crazy, it can have a really big impact on the price.
Yeah, right. And this gets into a whole thing that we don't really get into here too much today, but it's how do we even measure prices? What's an accurate way? The really low volume, can they be manipulated? If things that are stable coins that rely on, underlying assets that involve margin, will stop you out if you hit some certain level. How are they calculating that level? Can that be manipulated? That's its own can of worms that, in some future presentation I'd like to get more into. All right, so part 2, what's going on in our-chain trading? What do we need to know? Why should you care? And many people here, right, get paid in rocks, but we have dollar liabilities, right? We might have to pay taxes. We need to at least understand what are the ways to move rocks into dollars and how to not get ripped off, because, I like all you guys. Really don't want you guys to get ripped off. All right, so this is a day in the life of, right? This is what rock trades against, right? You can never get dollars. You can either get Bitcoin or you can get Ether on KuCoin. You can see the main exchange is ChowX, and then KuCoin, and there's a new one that popped up, BTC, that popped up last Wednesday. We will talk about all three. So we can also see, right, BTC swings a little bit, 62K here, 13,000 there. We can get more into that in a little bit. So ChowX has some weird thing called code, about code. I don't know much, but let's click the button. Join ConQ, whatever that means. That's what happens with code, right? It's all in Chinese, so let's Google Translate, right? We're getting really in the weeds and getting out there now. Got to get KYC3. Uh-oh. I don't know what that means, but ChowX is not a straightforward operation, it seems. You got code and stars and stripes and blue and KYC3 and Chinese language. So it seems to be, if we look at this, users can obtain the redemption authorization through the authorization of the witness. I have no idea what that means. Kind of freaks me out. Probably should be a little bit careful before we go do ChowX things. They have some nice thing about the team, though. That's under, if we hit the button, we. All right, so I went through a little bit of the work for you guys and looked at what it would take to ever withdraw your money from an exchange. It's always important before you start trading on an exchange to do like a test withdrawal because they might try to get you. And I look at ChowX, they need to do level 2 of KYC first before you can withdraw money. So they'll happily take your money, you can go put it on the place, but you can't get it out until you meet their system, and maybe they have no one to verify you for 6 months, and be careful, guys. It's the most liquid exchange. What do they trade? A lot of Skycoin. I don't really know too much about Skycoin, but it seems like they trade more of that than everything else combined. In general, it kind of freaks me out. Do you like them? All right, I want to. Okay, story for another time. All right, let's look at KuCoin, right? Not too much crazy going on. Here's a little idea of the UI. As we can see, the market here is very illiquid or very thin. We're going to get into what that means. We can get into it now. So if you look at it, right, the difference between the bid and the ask, right? Let's look at this order book here, right? 0.002458. So that means that 1 ether divided by that number, which comes out to say 400 or so. Well, 400 rocks will get you 1 ether. Yeah, look at that, 400, almost 1 ether. But there's only 47 there. So the price between 24.77 and 23.60, which is about 5%, is only made up of $3,000, $2,000, right? So the difference between where you can buy easily and where you can sell is 5%-ish for about $2,000. So not very much. So we call this a thin market, which means that a little bit of trading that you do will greatly influence the price. And the thinner the market is, the more you need to be patient and take time to get out of position. It could be days, it could be weeks, but you just need to do it slowly, because if you try to do it all at once, you're going to end up pushing the market. Everyone will see that you put in some bid here for $10,000. That's way bigger than everything else in the whole order book. They're going to then cancel all their sell orders and move them up even higher, and then you're in some kind of race, and that's really, really terrible. So in general, a good rule of thumb is if you look at a daily traded volume, you can move about 10% of that safely without causing lots of pandemonium. This is a fun chart, right? So our ETH chart was okay, but our Bitcoin one spiked down 30% in a hot minute and then came all the way back. What happened? Beats us to BTC, the latest new one that came out on Wednesday. So they were trading, if we look over here at this volume chart, $1.5 million for the first 4 days of trading from April 10th through this weekend. And then today, they're currently trading $194 worth. So how does that make any sense? The thing traded the whole time in this 30% range. Super duper sketchy, right? How do we go from trading $1.5 million in a day to $194 in a day? Right? This is where we're going to talk about thin markets too, right? The fact that the price can move this much on this little volume, sometimes on this much volume, means that it is very thin and you just need to go slower with your trading plans. So diving more into the BTC, we can see that ETH Bitcoin, kind of trades normal there. So that gives us a little bit of hope. But what kind of fees do they charge, right? Here's how we start to get to the bottom of their schemes, right? Trades, 0.25%, that seems pretty normal, that's okay. No fees on deposits, all right. Withdrawals, our intention is to not make any profits on withdrawals. They don't define anything. Start to get to a red flag. Let's see if we can find their withdrawals, 0.5% for everything. So you put your money in, you take it out, you get ripped 0.5% on everything. So let's get some theories working, right? BTC created a bunch of fake volume to attract traders, which is called wash trading, which I'll get into, and then robs them on withdrawal fees, right? So what they do is they have say I'm Mr. BTC, and then I make one account here, and then I also make an account here, and then I just trade against myself in this huge range where no one else is really trading for $1.5 million to make everybody in the whole space think, hey, I can do a whole bunch of trades on BTC, they have liquidity, let me go put my money there. And then they just stop doing that. Everyone has their money there. They're like, man, there's nothing to do here, let me withdraw my money. And then they just rob everyone 0.5% on their money. Right? Another idea is they hired a market making firm, and the market makers tried to market make, and they were just terrible at their job, blew up. That accounts for this 30% range all the time. That's like just them panicking and doing crazy things. And they just walked away from continuing to try. So they were doing $1.5 million a day, and now they just gave up because their boss told them you guys can't keep doing this. But either way, right? It might look enticing to go put your money on BTC, but you need to really know what you're signing up for, because people are always trying to scam you in crypto. That's that's how people live their lives. And what is going to be your retaliation from this exchange that I don't know anything about that's probably domiciled in China, right? They're probably just going to take your 0.5 and you're going to call it a day. But yeah, please don't put your money on BTC. Fun one, let's look at how they traded Golem. Went up a lot. There are no sell orders. That gives me the old sketchy vibes. So let's look at this Golem pump, right? What happened? Looks like they launched their mainnet. So we can see on Poloniex they also went up, this is versus Bitcoin, about 100% from 0.0, a bunch of zeros and a 3 to a bunch of zeros and a 6, and then came down a little bit. Roughly 100%. Where else does it trade? Upbit, Korean exchange. Golem got listed on the Korean exchanges and such, and that's where they get way more volume than almost everywhere else combined. We look there, whoa. Went up from some unit of Korean won of 428 all the way up to 1800, so 4.5x before coming all the way back down. We look at this one of Hubi, where it's second most traded volume, $5 million a day. They went up 3.5x before coming all the way back down. So conclusion, our bots are cool. If you had some way to have a bunch of money, a bunch of crypto and a bunch of dollars on all the exchanges, and you could have some sell orders when you saw this happen, and then buy back the GNT with over on Polo where it only went up 100%, you could make a ton of money, right? And this traded a ton of volume, right? $50 million here, right? Super liquid. So if anyone wants to do programmatic trading, it's still very profitable. Everyone always thinks, it's not going to be profitable tomorrow, but fact, this happened last week, still super profitable. And if you're running a programmatic trading bot, you might not even care why it pumped. You might not even care what Golem did. All you're looking for are these kind of opportunities that can be really, really profitable. One more case study. Ripple donates $29 million. What does that even mean? Do they donate ripples or dollars? And if they donated ripples, were they sloppy with their conversion of dollars? And can we catch them? I don't know if anybody has any guesses. Do we think we can catch them? All right, so let's see what they did, right? Looks like they gave the money to a bunch of classrooms for more than 28,000 public school teachers across all 50 states. Sounds like they need dollars, right? Because they can't pay teachers in ripples. So they're gonna do some trading, quite possibly. Why would they do this? That's awkward. Tried to bribe the Gemini with $1 million and the Coinbase with $100 million, and they said no. Probably got to get some good PR in the house. So what are we looking for, right? Some ignorant trader was just like, I got these Ripple, they need dollars, let me go dump them all at once. And I would expect this to occur on some exchange where they'd be able to get US dollars, because they probably can't pay American school teachers in tethers or Korean won or euros or something. So this is where we trade, right? So let's just take a quick look on how all these things go, right? So I shoved all the charts together, right? We have in order of liquidity, we have Bithumb, then we have Hubi, so we can check out some tethers. Bitfinex, I would very much expect, they do wires, they do dollars. Kraken, that's another one of the people's favorites, and Bitstamp. So we looked at it, and if we look here, there's no real place where there's a big market order candle down. What we would expect is all these charts, right, kind of have the same kind of pattern like that, right? All of them. And down here are volume bars, volume bars, volume bars. All of them do this, right? And there's no point where they all do this, and then one of them does that on some kind of volume, all these candles are kind of uniform. There's not one where huge volume, right? So from my best guesses, it doesn't really seem like the guy was an idiot, There's still time, maybe he'll do a thing, but it seems like you might think Ripple has some kind of professional traders who have some idea what they're doing, and maybe thought about it, or actually sent the school teachers US dollars from the start, because they effectively manage the treasury. All right, that's part 2. If anyone has any questions.
So given the volatility on the asset, seems like the options premium should be pretty high on this. Is anybody doing options either on Bitcoin or Ether or anything like that?
Not that I know of, but options are really hard to price even for capital markets.
And liquidity is an issue also in the options market. So nobody's doing options at this point.
Not that I know of. I would expect it to be like a very long time before options really got institutionalized, because think about how much, like the amount of volatility in options in capital markets in the S&P 500,
right,
which is only, over 20 years gone up 3x and down. Something that goes up, 60x in 8 months, it's going to be crazy hard to price.
The second question is, so based on all your analysis, which is the best exchange or top 2 that you would trade in from a liquidity and non-scamming perspective? Right,
so one, it depends what you want to trade. Are you asking about our chain? Are you asking about all of crypto? What I do is I just go to CoinMarketCap, and then you can sort the currencies by daily traded volume. And I just look for which ones do the most volume, and then I try to figure out which ones are scams, and I test out by putting a little bit of money on them and then withdrawing that and then seeing what kind of hoops they make me jump through. Then I make some decision based on that.
So what's the summary of the decisions you made so far?
In trading our chain, I think KuCoin so far seems the best, but there's some Chinese exchange that we probably can't really interact too much with if something went wrong. So don't keep very much money in any exchange if you're trading our chain. And then also, if you need to move more than 10% of a daily traded volume, your best bet is to find someone to do an OTC trade with. That's over the counter. That means literally selling someone a large amount for some fixed price versus going to go try to interact with the exchange. So I'd highly recommend, if you trade illiquid things that don't trade very much, trying to find people to do individual trades with is going to be way better than sitting on KuCoin, for 20 hours in a day for 5 days.
All right, thank you.
Sure. Any other questions? All right, we will move on to part 3, risk management. So what's your current risk position, right? Do we feel comfortable that we can buy lower or that we could sell if things go higher, right? And we can also group things into the speculative part of our portfolio versus the core part of our portfolio. But regardless, you need to not bite off more than you can chew, or you're going to make bad decisions, right? You're going to get very emotional. It's going to be really, really exhausting. You're going to be up all night staring at the chart, doing a lot of praying, right? You're not going to be doing the building and how I want you all to be doing all the building. So how do we avoid it, right? Get rid of your FOMO, right? People do this thing where they see it go up a lot and other friends are making money and they get jealous and I want to make as much money as they make, going forward. But that makes you start to try to buy things as they go higher, and we're trying to buy low and sell high. Taking profit, right? You need to have some plan, almost make a take profit schedule. Literally, right? Ether's at 500, say. Make some plan, when Ether gets 600, I'm going to sell 10%. When Ether gets 700, I'm going to sell 5%. And I don't care what your plan is, make some plan and then follow through on it. And that's you'll be amazed at how much just making a plan will be able to help you manage your risk. You don't always have to have a full position, right? You don't need to be all in all the time, right? That's a recipe for disaster, right? I'm all in, I own all this crypto, I have to pay my rent in dollars, landlord's knocking on my door, you haven't talked to me in 2 days, I'm just hold on, maybe Ether will bounce a little bit, we don't want to be there. And then being willing to stop out and take a loss, right? You set some level, at which point you're hey, I have some thesis that Ether's going to change the world, and if it hits 100, I know that I'm going to say that it won't, and I'm going to stop out. Or maybe the way you trade it is, hey, Ether could go down to $1, but it ultimately will go back, to $1 million. So I'm not going to have a stop loss, which means I'm going to take a smaller position, right? So stop losses can be some almost way to have leverage where you can take a bigger position because you have some ability to say, if we go down 40%, I'm out. So the one theme of all this is you need to take what the market gives you, right? We want to have some kind of way for when things go up, we're trying to sell more. When things go down, we're trying to buy more versus trying to chase the market. So here's a good example, right, of a trade setup that I really like, right? And this was Ether Bitcoin during the DAO hack. I love things that I call this capitulation, right? Which is some idea that, imagine that you were long this thing, right? And it traded like this, right? And it went down, and then oh, I'm up a little money, and then it went back down, and then, oh, I have hope, and then it went down, and then, oh, I really have hope, and then did this, right? By the time you get here, you're so exhausted, you're just get me out, I can't take the pain anymore. And if you were short, you're doing the exact same thing. So if we come back here, right, this is a classic capitulation, which I like to define as a local low on a high amount of volume that cannot make much more of a low than the previous low in like the previous candle, right? So every candle here represents about 30 minutes, right? And we see this one here where the price went down a lot, came on a lot less volume than this one here, where the price couldn't really go down too much, right? We only went from like here down to here. And that to me, if at minimum gives you bumper cars where at least you're trying to buy low and sell high, because you're only buying at local lows and you're only buying on like these big like washout moves. And in general, when someone's doing this in the capitulation fractal, I like to try to take the other side. And I figure if I can just take consistently trading, no matter which way, long, short, or the other thing, I take the other side of people capitulating, I'll probably do well in the long run. So here's a quote I really like from Reminiscence of a Stock Operator. If you ask like any of the capital markets guys, Mike Novogratz, any of these guys, they say it's like the best book to read about capital markets. And what this quote talks about is hope and fear, and how they are the worst thing ever for a speculator. And when the market goes against you, you're just like praying and you're hoping and you're hoping and you're hoping. And when the market starts to go up, you're getting greedy and you're hoping it'll go even more, it'll go even more. And then when it's going back down, you're fearful that you're never gonna have any money again. And these kind of things are really like at its core what leads to this capitulation and this kind of behavior in these kind of games. So there are two types of traders. Those who are scared of pulling the trigger and those who overtrade. I, for example, way more fall in those who overtrade, but each one gives something up and takes something back. So those who are scared of pulling the trigger, right, might have a genius idea, but they might miss it. So if you do things like make a take profit schedule, you put in a level of like, hey, I want to buy this thing at this price, the more you can pre-plan it, the less it feels like you have to make some really important decision in a moment, the more you're going to protect yourself from that. And for those who overtrade, right, the thing you suffer from there is always trying to be a hero, always trying to have all your money, like take way too much risk, biting off more than you can chew, etc. And what you need to do is really quantify from like a portfolio perspective, hey, I want to have this percentage of my money or my money allocated to trading crypto in a thing. Hey, here's my plan if it goes down. I want to have this percentage. If it goes up, I want to have this percentage versus, oh, went down a lot and, all in. So things I like to buy. Capitulations at the lows and when we can't sell off, right? And we can see that in this chart. Real capitulation in this huge volume at the lows and we couldn't go even lower. Things I like to sell when I feel satisfied with the trade and when I need to maintain flexibility, right? So big spike ups. In general, the faster we run, the less bullish I am, right? The more things go up quickly, the less bullish I am. Because if you think about it, right, like the slow grinds are like more new people finding out, etc. When the thing shoots up, that can be a lot of shorts capitulating, that can be lots of panicking, and in general, you're going to win if you take the other side of those kind of things. Ideally, I like to on high volume. So this is a huge thing that a lot of people miss. If you're a really big player in these markets, right, and we talk about how you can only move, say, 10% a day, right, that's like 30K, right? That's like not too much. When things really make new highs, they trade in lots of volume, right? You see it in our chain, right? If we're trading 300K a day now, when our chain was making new highs, we're trading like 3 million a day. So there's this thing in markets that occurs where when things have really big moves up or down, a lot of times liquidity comes to the market. And if you're a big player, it's not only up to you when you can get in or out of a position, it's up to the market as well. And this comes back to taking what the market gives you. You might want to say that like Ether goes to 1,000 tomorrow, right? And it does this on a huge amount of volume, right? It might be at 1,000 tomorrow, but it's on low volume, and what would normally take you 1 day to get out will now take you 12 days, at which point you have to take an extra 11 days of risk, and that just needs to be factored in your calculations. So here's a good one to sell, right? And this is like literally 1 week after the capitulation, right? Where we can see huge volume, especially relative to the volume down here, on like some major spike up, that is like 65% in 24 hours, right? So there's one that like ran really fast, ran at an even increasing rate, and like that's just like a healthy time to try to sell some, not because you don't believe in the thing, but to maintain flexibility, right? So that way, if you get another one of these capitulations again, you can buy back, right? So we're like having some kind of natural way to like sell high, buy low, and like manage our risk and not bite off more than we can chew. So what do I lose in my strategy, right? If I miss it, I miss it, right? Like if I was looking for some capitulation to buy along this thing, there's no real spike down, so like I might miss it. And that's just like the thing that my strategy costs you a bit, and it's like a preference. I would way rather miss some more and not get FOMO and caught up in this thing, but have like a higher percentage of trades that hit than go for a strategy where I chase things. Right? If I take way too big of a position, if I'm a pig about it, I might have to capitulate, right? I bought off more than I can chew. I got the landlord knocking at my door. I got all these dollar liabilities, and I have to get out because I have like real life obligations that I have to meet. All right, my last one, and one more quote from Reminiscence of a Stock Operator, is it's really important to like know yourself and your style of trading, right? And very often it's not about like, this quote really talks about, it's not about, you know, having trouble evaluating things or things like that. It's like making internal mistakes. And very often you'll see people that think they're geniuses, like the Wall Street fool in this example, who just thinks they have to trade all the time. And he makes an internal mistake by not like taking his time, trying to find good setups, chasing charts like this. And that's what's going to defeat you. It's not going to be like, oh, I don't think that Ethereum is a good long-term bet or something like that. Most of the time it's going to be biting off more than you can chew, trying to trade way too often, 24/7, being really tired, staying up all night, not working on your DApp. That's it. Any questions? Okay.
I have a question. So do you do any automated trading, or do you have any automatic trading setups?
You know, I don't. And I've been trying for years, and I keep thinking I'm going to get one to work out, and it just seems to never do. So, you know, I'm still stuck doing all my trades by hand, but maybe someday. I keep hoping.
Do you have any intuition as to why it doesn't work?
That's a long story I'll tell you about over many hours.
Excellent.
So there are a lot of dApp developers or potential dApp developers in here, and we're going to raise money in crypto, whether it's via an ICO or some other way. So from this risk management perspective, what kind of advice would you give them who may have dollar liabilities, like you mentioned, manage their portfolio of?
Yeah, so what I think is important is really being able to, if you're a dApp developer, what matters, right? The thesis is, I'm going to build my dApp, and once I build my dApp, it's going to add value, and then things will work out for me, right? And the biggest risk is I run out of money and I can't build my dApp, right? Because I manage my treasury wrong or anything like that. So what's really important is like figure out what your dollar liabilities are going to be, and like really come up with some plan that you're not going to run out of money, right? Because you might lose some money because you own some rocks as a company or whatever it is. If you have enough dollars to always be able to build your thing, right? That's going to be the best thing for like the art chain space and the best thing for your dApp, because you're always going to have like a runway. So I would really advise like hammer out what your roadmap looks like. You know, what are the things that I can't pay for in cryptocurrency, right? You want to incorporate a company, you can't really use cryptocurrency for that. And like really get on that page and then make some strategy that involves getting the amount of dollars you need to like hedge your future, to like guarantee a runway. Anyone else? All right, well, thank you guys.